The first meeting is really a get-to-know-you meeting. We're going to sit down. Typically, the meeting will last about an hour. We're having a conversation. My job is to ask them some questions about where they are, what some of their goals are, what some of the key objectives they have in meeting with me, where they are to this point, and really what brought them in to see me. And now I'm at the point in my career where I have a lot of people that are dependent upon me to provide them with all the guidance and all the advice that we do on a day-to-day basis.
You spend your working years trying to build up your assets, trying to build up pension credits at your job, trying to grow your nest egg so that you can one day retire when you can't work or don't want to work anymore. And that's a period followed by phase two, which is retirement. And your priorities in these two phases are very different, but many times we see people don't make that shift and they still act like they're in phase one when they really should be acting like they're in phase two.
We're going to talk to you about what we commonly refer to as the second half of the game. And what I mean by that is you're working your entire life towards retirement, and I'm assuming that most of you are, at that age where you're starting to consider some of your options as you move into retirement. And as you do that, you're moving from what we call the accumulation phase of your life, where you're accumulating your assets. Maybe you're participating in your company's 401k, maybe you're contributing to an IRA account or a Roth IRA account or some type of retirement vehicle. And now, as you retire, you're transitioning into the distribution phase, the part where you're going to need income in retirement. So we're going to talk about some different ways to do that with an emphasis on Social Security.
Hi, and welcome to Financially Speaking with Jeff Bush. My name is Barry Warnker, and I'm the host of today's show. And what we're going to talk about is something that many consumers have experienced over the last 5 years or more, and that's been very low interest rates. And while low interest rates can be really helpful if you're buying something, a house or a car, and you want to finance it, that's great. But if you're trying to create income in retirement, that's low interest rates make it a real challenge for folks, and that's a lot of what we're going to talk about today. And in fact, we have a free report we're offering, which is really it's called Alternatives to Certificates of Deposits. Oftentimes certificates of disappointment with the rates that people have been getting lately, but it's a good report. It talks about a lot of the different things that people can do, including certificates of deposit or CDs and some other instruments. So it's educational and it's a free report, so we'll tell you how to get that free report if you want it later on in the show. And anyway, so that's kind of a little tease there, Jeff. But anyway, welcome to the show.
Hello, Barry, and welcome to the show. Good to be here again here on PCTV. CDs are very popular with investors for so many reasons. Let's spend a few minutes discussing why certificates of deposit are so popular, Barry. First, CDs are safe. They're FDIC insured up to $250,000, which means the federal government insures the principal. CDs are predictable. One knows exactly what they're going to get out of a CD when they purchase one because the interest rate that they earn is a constant, unlike some of the other financial instruments. And we'll start talking about those a little bit later in the show.
Sure.
CDs can be used as a good income generating tool. Many retirees utilize the interest from their CD as retirement income. So you buy a CD, you get 1 or 2%, and that's predictable income. CDs are fairly liquid. If one needs access to the full value of the CD, you can get it, usually by forfeiting some of the interest you have gained. So let's talk about that for a minute. So if you go out and purchase a 6-month CD, that means that every 6 months you have entire liquidity, full liquidity to that instrument, that CD.
You can cash it in.
You can cash it in if you want to. Now, if you can't wait the 6 months, so let's say it's 3 months, and you have a major car repair bill and you need to cash in your CD. So what happens? Well, you have forfeit some interest. So there's a calculation, there's a formula that the bank has, and they forfeit a little bit of your interest. So it's a fairly liquid investment. So Barry, we want to talk about a little bit about the disadvantages.
Well, just to back up for just a second, I like the advantage of having it liquid. I like the fairly liquid. I like the advantage of having it predictable. What I don't like is getting 1 or 2% on money when we know inflation probably is easily 3 or 4% a year.
Yeah.
So that's
a good teaser for later in the show.
Is it okay?
Yeah.
Well, I get ahead of myself sometimes. You know how that goes. But I remember my mom.
I've never seen you do that before.
My mom and dad back in the the 70s and the early 80s. I mean, they would buy these CDs. They pay like 10, 12%. It was easy. Now of course it was a very inflationary time, and it wasn't a great time to be borrowing money to buy a house or a car or a big purchase. But if you were in the business of just generating income, when rates were super high, CDs were very attractive to a lot of people. For all the reasons you mentioned, plus
it's all relative though, because
different ballgame now.
The CD rates are all the interest are obviously tied to interest rates, and interest rates are tied to inflation. So you were getting 10% maybe on a CD, but inflation was probably double digits as well.
Yep.
So
anyway, so those are some, we talked about the advantages and some of the disadvantages you mentioned. I noticed that how are they treated tax-wise?
Well, the CD interest is 100% taxable, regardless of whether one uses the interest as income. So let's just say you're using it as an accumulation vehicle. You're really not spending that money. The interest is taxable regardless. Now, of course, I have to put a little caveat in here, and that, of course, is that if the money is in an IRA, then you follow the rules of the IRA. The other thing, in a low interest rate environment, CDs can be very low, and that presents challenges for retirees who rely on that income when it comes to renew a CD. So what we saw happening a couple years ago is every time the CD would go to renew, it would renew at a lower rate. As interest rates began coming down, every time they went to renew.
And we'd see in our practice, we'd see clients who they might own 3, 4, 5, 6, 7 CDs. And how did this happen? Well, whenever I had some money, I would just look in the paper or wherever and try to get the best rate. Well, now they got 10,000 at this bank, 5,000 at that bank, 2,000 at this bank. It's a kind of a headache keeping track of it, and they're making 1 or 2% on the instruments, and then they're paying taxes on it.
Yeah.
So if they're in a 25% tax bracket, they make 2%. They end up making 1.5%.
Yeah.
And they got to run all over town to do it.
Exactly. Yeah. So we're gonna get into that a little bit later, Barry. The name of the report is Alternatives to Certificates of Deposit. So if you're interested in getting this report, you can just give us a call, send us an email, and we'll get that report right out to you. There, we have the information up there on the screen. Okay, moving right along with these CDs. Another thing that you have to remember with a CD is time commitment. So CDs require you to commit your money for a certain period of time. So as interest rates become more favorable, you don't get benefit of those higher rates. Now we're gonna shoot the rates up on the screen here in a little bit, but basically what happens is if you want a higher rate of interest on your CD, you're going to have to purchase the CD for a longer duration of time. We call that the yield curve. So the longer that, in fact, why don't we do that? Why don't we put those rates right up on the screen? Okay, so we got these right off of bankrate.com. So these are current CD rates, okay? So if you purchase a CD for 6 months, on average, this is what you're going to get, 1%, okay? So if you purchase it for a year, you're going to get 1.2%. And then you can see that as you progress over the timeline all the way out to 5 years, your rate of return is 2.25% on a 5-year CD. So we call that the yield curve. So the longer you hold the CD, the higher the interest rate is. Now, that becomes problematic when the interest rates are going up, because if you buy a 5-year CD, you're locked into that rate for 5 years, okay? So what happens if in 2 or 3 years the interest rates start to go up? You can't do anything about it. You have to hold that CD to maturity to get your 2.35%. So that's one of the problems with buying a long term. And really, but let's go back. Let's put those numbers back up on the screen. The CD rates. So you can see there that the yield curve is not very steep. So if you buy a 1-year CD, you're going to get 1.2%. If you buy a 5-year CD, you're going to get 2.25%. So you're only getting a 1% premium for those extra 4 years. So we would likely advise in this interest rate environment, if you're going to buy CDs, you would be buying them at a short-term rate, because it's just not worth tying your money up all that time to get 1 extra percentage point. So anyway,
so you've got it. So one of the downsides is a time commitment, and we talked about taxability. Whatever, if you're taking the money out or leaving the money in, as long as it's not an IRA, you're going to pay taxes on the return that you get, and again, it's kind of tied to inflation. We see an inflationary environment. When rates start to go up, CD rates tend to go up. So we've got to be leery about locking yourself into something that's at a relatively low rate now, and then you're locked in for 5 years, and a year from now the rates go up substantially.
Yeah.
And you're kind of stuck.
Yeah. I mean, the other thing with regards to inflation, if you're getting 1% return on your CD, we know that inflation is higher than 1%.
Sure.
I mean, if you just look at the goods and services that you're purchasing, and so your CD is not keeping up with inflation. So we call that inflation risk, and that's something that you may think that there's safety to principal with a CD, and that's certainly true. But you are still taking inflation risk with that instrument, especially going back to that example of the 5-year CD where you're making 2.35%. We can probably say there's a pretty good chance inflation is going to be more than that over the next 5 years.
Remember Ronald Reagan, who people seem to remember some good things about the guy, and one of his quotes was, "Inflation is the thief in the night that steals your money."
Yeah.
And it's a silent thief, because you really don't know it unless you really kind of brought to your attention. I mean, you think about the house that your father might have bought for, I don't know, $10,000, $20,000. Well, today the exact same house might cost you $100,000.
Yeah.
Now, if you still safely held on to that $20,000 that you had back then, well, it lost 80% of its value, at least relative to buying a house.
Yeah, and Ronald Reagan would know, because he presided over some very high inflationary times back in the 80s. The other thing is...
But he always smiled through it.
Yes, he did. Social Security income taxation is another sort of a hidden tax there, because what happens is many retiree CDs, this income from the CDs can adversely affect the level of taxation on their Social Security income benefits. And what I mean by that is the added interest on the CDs could make more of your Social Security benefit subject to income tax. So it's kind of like a double whammy. You're paying tax on the CD, and then it's causing more of your Social Security to be taxed.
So
as well.
So a lot of people, when they're trying to help themselves, inadvertently, by getting another $1,000 or $2,000 or $3,000 a year of income, they could accidentally bump themselves up into the point where, instead of paying no tax on Social Security, 50% of their Social Security could be taxed.
It could be.
So that's something that people don't always realize, and that's a lot of what we help people with to avoid that problem. So we kind of went over the current rates and how that they're low, and so people start looking around. Okay, well, Jeff, so maybe CDs aren't so great right now. What else can I do?
Okay, bonds.
Okay.
First of all, the first thing that we want to talk about when we talk about a CD alternatives is bonds. Why do I say that? Because the bonds most simulate the CD with some very important distinctions. Bonds tend to offer higher interest rates compared to short-term investments such as CDs. The reason for that is just the timeline. We showed you on the screen the CDs. You can usually only get a CD up to 5 years, whereas if you go out and purchase a bond, it usually starts at 5 years and can go all the way up to 30 years. Okay, so the interest rate on a bond is typically higher than the interest rate that you'll find on a CD. Now, there's different kinds of bonds. There's government bonds, there's corporate bonds, there's junk bonds, there's, and all these different types of bonds have different levels of risk unto themselves, and a different interest rate. But in generally speaking, the interest rate on a bond is going to be higher than the interest rate on a CD.
Take a minute with that, because many people misunderstand bonds. Because I've heard somebody will say, well, at bond, if I put $10,000 in that bond, my money's guaranteed, and it's safe investment. And to some extent, that's fairly true. But you have to understand who is offering the guarantee.
Okay.
And
okay.
Where's
so
the risk?
Let's talk about that.
Yeah.
So your interest is safe and guaranteed under a couple different scenarios here. So number one, you have to hold the bond to maturity to guarantee that you're going to get your money back.
Okay.
So if you buy a $10,000 bond and it's got a 5% coupon rate on it, you've got to hold that bond to maturity to make sure that you're going to get your $10,000 back, on top of all that interest that you're going to get along the way, which we call coupon. So so if it carries a 5% coupon, you're getting 5% interest along the way. But to get your $10,000 back, you have to hold the bond to maturity. So that's one thing. Now, along the way, there's always a market for the bond. There's always what we call a secondary market for the bond, unlike the CD. So the bond has a ready market for it. So if you buy the bond today and 6 months from now you want to sell it, there's a market for somebody to buy that bond on what we refer to that as the secondary market.
So if it's a $10,000 bond, does that mean I'll be able to sell it for $10,000?
No, it does not. It means that you're going to be able to sell it for whatever the market's going to bear. Okay, so and the best analogy I'm going to use here, Barry, is a seesaw. Okay, so if interest rates go up, the value of your bond is going to go down. If interest rates go down, the value of your bond is going to go up. Okay, so there's some risk inherent in buying that bond, insofar as you're buying it at today's interest rate, and you don't know what is going to happen to interest rates in the future.
I see. So if I buy it, and in the market, that type of bond pays a 5% coupon, and I buy it for $10,000, and then I look up a year later, and I can buy a very similar kind of bond, but it's going to pay 6%. So I can get $6,000 a year instead of $5,000 a year. So what does that do to my $10,000 bond that I bought a year ago?
It makes it, remember the seesaw, it makes it worth less.
Okay.
Interest rates went up, value of your bond went down. Okay, so that's one thing. Now, if you hold the bond to maturity, that risk goes away, because when you hold that bond to maturity, it might be 30 years, but if you hold it to maturity, you're going to get your money back. So that's one kind of risk. Now, the other risk is who's issuing the bond. Okay, so if it's a corporate bond or any kind of like a high yield bond or a junk bond, you see all these terms thrown around.
Yeah.
Then you are relying on the credit risk, the safety and credit risk of the issuer of that bond.
A company or a
company
institution.
Yep.
Okay.
So you're relying on their credit, and generally speaking, and of course, then you have all these, you have these rating agencies like let's use like Moody's, for example, is a common rating agency. So they go out and rate these bonds, and the higher the rating, the safer the bond, the more likely that they're going to pay it, and the lower the interest rate.
So you can see why people get confused about bonds. It's the kind of upside down world. You own a bond, and you hear interest rates went up. You say, well, that sounds good. No, if interest rate went up, the value of my bond went down. Oh, well, that's not so good. So it's like everything seems to be kind of opposite world, when good news is bad news and bad news is good news. So people get confused.
Yeah, that's right. It is a little bit confusing. There is some risk inherent in buying bonds, but I would just make a general statement that says if you're holding bonds for a long period of time, you're going to do much better than you are going to with buying a CD.
Yeah,
if you're willing to take of what we call bond risk.
So I guess the bottom line is it's buyer beware, though, and don't assume just because you see the word bond that that's going to be exactly what you think it is. You need to talk to someone like yourself, Jeff, who really understands bonds and the market and risk and reward, and develop a bond portfolio if that's what you want. You need some expertise in it because it's really there's opportunity. But with opportunity, there's also danger and some risk.
And there's a couple different ways we handle that at our company. We like bond funds,
certain ones,
bond
yes.
Mutual funds, because they can diversify the bond risk a little bit more. Because when you're buying into a bond mutual fund, you're buying, several hundred, maybe even 1,000 different bonds within that bond fund. So the default risk that we were talking about earlier gets diversified when you have a portfolio of many different bonds. So that allows the manager of that bond fund to go out and buy these bonds. So the default risk really becomes a little bit less in that situation. So we like buying bond funds.
Good.
In that
and I know you have a handle on that, and not every fund is a great fund, and you have to kind of do the search and the research to find the right fund, and keep an eye on it too, because the right fund this year may not be the right fund a year or two down the road. So we covered CDs as an option, and we covered bonds as an option for generating income. Let's talk about annuities, because annuities that's probably one of the most misunderstood words you can use, because I can't tell you how many times I've sat down with folks and they said, my brother-in-law or somebody said, I think I need an annuity, and they have an idea of what an annuity is. And really, there's so many different varieties of annuities and purposes that they serve and limits that they have that, again, that's something that requires some expertise.
Barry, it's like walking into the ice cream shop with 31 different flavors. I mean, there are really a lot of different kinds of annuities, but suffices to say that oftentimes when you go out and buy a particular annuity, maybe a fixed rate annuity, you're going to get a rate of interest that's higher than a CD or even a money market. So we'll talk about that for just a minute here. So first, let's talk about who's guaranteeing the interest rate, okay? Because when you buy a CD at the bank's guareteeing the interest rate, and it's FDIC, insured, Federal Deposit Insurance Corporation, insured, okay? You're not going to get that with an annuity. With an annuity, you're buying it from an insurance company, and your guarantee is based on the claims paying ability of the insurance company. That's an important distinction. So in many cases, you want to buy the annuity from a nice big insurance company with nice high ratings, okay, which makes the investment relatively safe, okay. It's not quite the same level of guarantee that you're getting with an FDIC insurance instrument, but it's pretty darn close.
Sure.
It's pretty darn close.
So what are some of the disadvantages of having an annuity?
Well, a couple things. First of all, by definition, these are retirement vehicles. So if you take withdrawals from an annuity before you're 59 and a half, you're going to get penalized. So it's kind of like any other retirement vehicle, like an IRA or a Roth IRA or your 401k or any kind of retirement instrument like that. If you take the money out before you're 59 and a half, you're going to be subject to taxes and penalties.
Okay.
Okay. So you have to be mindful of that. If you're going to buy an annuity and you're 30 years old, you better make sure that your time horizon is such that you're okay getting to 59 and a half with it. If not, you're going to be you're going to be penalized. So you got to be careful about that. Most annuities have early surrender penalties. Okay, so what happens is with an annuity, you may be tied up for 3 years or 5 years or 10 years or maybe even longer. So you need to know what that is. And generally speaking, a lot of times the longer that surrender period is, the higher the interest rate or the higher incentive the insurance company is going to give you. So you have to really understand what that is, the surrender penalty. And maybe if you're 30 years old and you're buying an annuity for truly a long-term investment, maybe you don't care. Because you can't touch it till you're 59 and a half anyway. But the point is, you need to know what that is.
The fact that we're running out of time here, I think we have a couple minutes left, and I think rather than get into the ins and outs of annuities as one of the options to an alternative to a CD, because again, there are so many different kinds of annuities. We just have to realize that's one of the many alternatives that's available to people to learn about in our booklet, alternatives to certificates deposits, combating historically low interest rates that we have these days. So I think probably on our upcoming shows we'll bear down a little more and drill a little deeper into annuities, the many different kinds and the many misunderstood things about them, and the good, bad, and the ugly of them, and how they can possibly play part in your retirement plan.
Yeah, we can do that because you're right, Barry. That is a subject for another show. With annuities, there's so many different kinds of annuities. It's just important to remember that is an alternative to buying the CDs. So I want to mention a couple things here, a couple housekeeping things before we sign off here today. So to get your report certificates of deposit or alternatives to the certificate of deposit, you can call our office or send us an email. We'll put the information up on the screen, and we'll get that report right out to you. Second thing is, in addition to doing this TV show, we do live events. We take our show on the road, so to speak. So we have a couple events coming up that you can see right here on the screen. So if you want to call our office for tickets, you can certainly do that. We'll be out and around town in the days and the months ahead.
And those seminars are on the how to maximize your Social Security benefit. So if you attend one of those seminars, particularly people that are maybe their late 50s, early 60s, you'll get some great information on the opportunities that you have in making the most of your Social Security. And we have helped people literally get hundreds and hundreds of thousands of dollars more from Social Security than they ever dreamed they could, just by knowing some good information.
Yeah. So yeah, call our office, get tickets to our upcoming events. As Barry said, we'll be talking about Social Security. And again, if you want to, this is nice. We're taping this show for PCTV, and the show's broadcast, of course, on the local cable, and also on the PCTV website, which is thepctvnetwork.com, and also on our website, informedfamily.com. So with that said, we're going to sign off, and we'll see you next time for another exciting show for Financially Speaking with Jeff Bush.
Thanks.